Retiring on dividends is a great way to fund your golden years because at the end of the day, you're agnostic to whether the stock market is rising or falling at any given time, because all that really matters is whether or not your dividend income is enough to meet and ideally comfortably exceed your living expenses. And this is powerful because it mitigates your sequence of returns risk, because as anyone who's familiar with the stock market and dividend investing knows, dividends, especially from quality blue chip stocks in a diversified portfolio, are much more consistent and dependable than stock market returns. Stock market can be very volatile. One year can be up 30%, the next year could be down 20% or even 40%, depending on what happens. And so if you are in a situation where you're having to consistently sell shares of your stock in order to fund your living expenses, and you get stuck in a severe bear market and the market takes a long time to recover, let's say COVID hits and it's a pandemic that does not get defeated very quickly and it remains in place for a long time, where there's a devastating war that sticks around for a while, something like that, it could really erode your retiring purchasing power and destroy your retirement plans. Whereas if you're invested in blue chip dividend stocks that are well diversified against a black swan like, say, COVID, some companies were more impacted than others, but if you have a broadly diversified portfolio with blue chip stocks in place, your dividends, sure, they may still go down a little bit on an aggregate, but overall there's only going to be a very slight dent, much smaller dent than would be to your stock portfolio. And if you already have a little built-in margin of safety, you should be good to go. And in fact, many of these dividend stocks grow their dividends year after year after year. And so you're going to be much more stable, you're going to be able to sleep better at night, and your living expenses are going to be more sure to be covered for the long term if you invest in dividend stocks. Of course, like I said, that's predicated on having a well-diversified portfolio and also having quality dividend payers that can be depended on through thick and thin to grow their dividends over the long term, ideally at a rate that beats or exceeds inflation to protect your purchasing power. In today's video, we're going to talk about how you can do that by lumping the Schwab U.S. Dividend Equity ETF, or ticker symbol SCHD, with 3 other funds to create a very well-diversified, high-yielding, and dividend-growing portfolio to fund your retirement dream. But before we get in today's video, if you could please like this video, it would greatly help in its distribution and help me grow my channel. I'd greatly appreciate it. Thank you very much. Okay, so there are really 6 reasons why SCHD is such a great base for a retirement dividend income portfolio. And first and foremost, it's because its fees are so low. 0.06% expense ratio goes to the fund manager, making it among the lowest cost ETFs anywhere in the market today. And as Warren Buffett once said, performance comes, performance goes, but fees are forever. And so while SCHD has gone through periods where it's outperformed the S&P 500 and it's gone through periods where it's underperformed the S&P 500, it's had years where it's risen a lot, it's had periods where it's dropped a lot. It's also had years where its dividend growth has been exceptional and some years where its dividend growth has been more pedestrian. But regardless, that low fee means that over the long term, you're going to keep a lot more of your hard-earned money from your investment than you would if it was a lot higher and that money was instead going to the fund manager. So that's a big reason why I like SCHD so much. But there are 5 other reasons. One of these being its dividend yield. It has a near 3.5% dividend yield, which may not seem impressive at first sight, but compared to other broadly diversified funds out there, whether they be dividend funds like ticker symbol VIG, VYM, DGRO, DGRW, etc., it easily exceeds those, and it beats the S&P 500 by a long shot, in fact, almost 3 times. It also has very impressive dividend growth. Over the past decade, it's grown its dividend at an over 10% CAGR, which means that it's tripling or really quadrupling the long-term inflation average. And even in recent years, when inflation has been at an elevated level, it's still been growing its dividend faster than the rate of inflation. So even during a high inflation environment, SCHD is still growing your purchasing power, not only on a nominal basis, but in real terms. And so when you buy a fund like this and you have it funding your retirement lifestyle, you know that your purchasing power is very likely actually going to increase relative to your expenses over time, rather than barely keep pace or even shrink. And that means a lot. It helps you sleep well at night. Speaking of sleeping well at night, another reason I like SCHD a lot is because it's well diversified. It has over 100 individual holdings. It has 10% or greater exposure to 7 different sectors, and its underlying holdings are blue chips. Blue chip powerhouse dividend growth stocks like Coca-Cola, Home Depot, Lockheed Martin, etc. Companies that have been around a long time, have strong balance sheets, strong durable business models, and have driven very robust growth for the long term. Another reason I like SCHD a lot is simply the fact that its total return performance over the long term has been compelling. And this shouldn't be surprising given that its dividend yield's better than the S&P 500, its dividend growth rate's better than the S&P 500, it's well diversified, it has very low fees. And in fact, until the recent AI boom where mega cap tech stocks, which SCHD does not have any in its portfolio, those recently have surged ahead and delivered incredible outperformance. And that's enabled the S&P 500 to surge ahead of SCHD. But before that, actually, SCHD was outperforming the S&P 500 since its inception. And so SCHD has a very impressive track record. It's outperformed most of its dividend growth peer funds. In fact, the only ones that have outperformed it are ones that have a lot of exposure to these mega cap tech stocks that have pushed them into the lead in recent years. And so that's a big reason why I like SCHD. And in fact, it does have still about 10% or even a little bit more exposure to the tech sector. And so, it's not totally missing out on tech. It's just not in the mega cap stocks. But that leads me to my next point of this video. But before I get into it, if you could please subscribe to my channel if you haven't yet, I would greatly appreciate it. I'm trying to make these videos to give out free and quality content to dividend investors like yourself. And so the more people that follow my channel, the more distribution I get, and the more it's worth my while to put a lot of effort and time into making these videos. Thank you so much. Okay, so what am I going to say next? Well, SCHD, as you can see, has some flaws. It's underperformed in recent years due to its lack of exposure to mega cap tech. Some would say that its dividend yield is a little bit on the low side. Okay, 3.5% okay, but it's still below, say, the 4% retirement rule that a lot of people are told to target. Or simply they're saying, look, I don't have enough money. I only have, say, $1 million saved for retirement, and a 3.5% or even a little less, that's only about $35,000 a year. I don't know if that's enough to live on, especially with the inflation of recent years. Costs have gone up. So maybe you need maybe $50,000 or $60,000 or $70,000 to retire on, depending where you live, maybe even more. And so, you need to juice that yield a bit. So what can you do? Well, I think you can also look at the fact that it has very low exposure to real estate. It also has very low exposure to BDCs and utilities and other lending instruments like preferreds or whatever. It doesn't have any of that in its portfolio. And so what can you add to the fund to protect its total return outperformance potential, namely, especially it's missing out on the mega cap tech, just in case those continue to boom due to the AI boom we have going on right now, but also without sacrificing its yield, because those stocks generally don't pay much of any dividends, while at the same time juicing the yield a bit to better cover current living expenses and give us exposure to those other sectors that we lack, like real estate, lending and fixed income, and utilities and infrastructure. So what are we going to do? Well, there are three funds that help solve all these problems. The first one helps solve the mega cap problem and help juice our yield as well. And that's, you can choose either the JP Morgan Equity Premium Income Fund, which is JEPI ticker symbol, or the ticker symbol kind of sister fund is JEPQ, which is the JP Morgan NASDAQ Equity Premium Income ETF. And that one focuses more heavily, as a little over 50% of its portfolio invested in mega cap technology stocks. JEPI only has like 20% something focused on it, and it's more broadly diversified. So it depends how much you want to weight this fund in your overall portfolio. If you want to be predominantly SCHD to protect that dividend growth strength and have that lower expense ratio, which I personally think is a good idea if you can still get enough income to meet your retirement needs. But you can scale up and down as you want. But if you have a very large portion allocated to one of these JP Morgan funds, I would go with JPI because it's better diversified. But if you're just going to add like a small sliver, like maybe 5, 10, 15, 20% to your portfolio to juice the yield and give that exposure to mega cap tech, then I'd go with JPQ because, again, it's more focused on the mega cap tech, which is what you're really missing. Anyway, both these funds, they apply a notional covered call strategy, which is monthly, and that enables them to generate rich monthly cash flow premiums from these sold call options that they return to shareholders as a monthly distribution or dividend. This gives them a high single digit, maybe even some environments a low double-digit annualized dividend yield, which makes them very compelling yield stocks while still giving you that exposure to mega cap tech. On top of that, they have relatively low expense ratios of just 0.35%. So that's another thing they have going for them. Okay, so what are these two other funds? Well, another one is the Virtue InfraCap REIT Preferred ETF, and that's ticker symbol PFFR. Why I like that is it's just a diversified fund of REIT preferreds, and that helps us check the two real estate missing from SCHD, as well as the higher yield, and actually a third, which is it gives you access to preferred or fixed income, which is also something that's missing. A little bit more of a defensive, high yield, fixed income aspect to a well-diversified retirement portfolio. The dividend yield is well over 7%. It's covered by internally generated cash flows from preferreds and REITs, which REITs generally rarely go bankrupt because of the nature of their business model with the stability of real estate, long-term contracted cash flows, the relative liquidity ability to sell assets or at least hand them back to lenders at the mortgage level. So anyway, REIT preferreds are a great source of passive income. This is a great way to further diversify your portfolio and juice the yield, and it pays monthly, which again boosts your monthly cash flow, which a lot of retirees like. I personally don't care about it, but some do. Okay, and the last one is the Reeves Utility Income CEF. It's UTG ticker symbol. And why I like UTG is because it has a below 1% expense ratio ratio, which is quite low for an actively managed CEF like this. It has, as the name implies, most of its portfolio allocated to utilities, which again helps fill that diversification gap in SCHD. It also has some exposure to real estate, which again helps to fill in that gap. Yields over 7%, once again distributed monthly, boosting that monthly cash flow that you get. It has relatively low leverage at only about 17%, which is much more prudent than what some CEFs do, reducing the risk profile. And so when you add all that up, it can really boost your overall yield in the portfolio. Depending on how you weight things, you could probably get a 5, maybe even 6% yield when you combine all these funds together, while still getting the strong dividend growth of SCHD that should help keep you up with inflation over time, and broad diversification across numerous sectors, especially when you include these other funds. So there you have it. I hope this video helps you as you think about crafting a retirement portfolio, even a pretty simple one, just using a few funds like SCHD, UTG, PFFR, and JEPI or JEPQ. Again, if you like this video, please let me know in the comments below. Give it a like, subscribe to my channel. Thank you so much. See you next time.